Hi folks, this is the Wealth Doctor with must-knows about how to avoid business owners' tax traps and keep more wealth for you and your family. Don't be among the millions of poorly advised business owners and entrepreneurs that wind up paying untold billions in completely avoidable tax. Get tax savvy to get richer faster. Number one, don't use a Schedule C to file your business numbers. A Schedule C is just one form on your personal return. There's no reason to put those numbers on your personal return. You're far better to put it on a proper business tax return, have the business file its own tax return, like an 1120S for an S corp, for instance. And that's really important for several reasons. Number one, you won't wind up overpaying on self-employment payroll kind of taxes, which you do on a Schedule C. It's based into the formula for how Schedule C profits are calculated. And number two, it gets you off the IRS's audit radar. Schedule C filers wave a red flag. IRS expects there to be a lot of monkey business with Schedule C filers, so they scrutinize those. You're a lot safer and under the radar filing a proper business return. The next thing is minimize your W-2 compensation, your salary. We've seen some folks that take huge salaries on an S corp, and you pay all the FICA taxes and Medicare and the Social Security taxes on that. That's needless and avoidable. You do need to take reasonable compensation, but that's often a lot lower than what we see in a lot of returns. Don't use a partnership for an operating business. You wind up getting killed on payroll taxes there again. I mean, unlimited ceilings there. You're much better off to use an S corp for an operating business. Make sure that you set up a real retirement plan, like a 401k or a defined benefit plan, depending on your situation. These deductions can be huge. They go right into much of it goes right into your family wealth, into your pocket, as it were, into your account. And the IRS, based on the recent tax law changes, will actually subsidize the creation. There's pretty big credits to set these up. So you want to take advantage of that while it lasts. Make sure that you're not missing legitimate business deductions, and this is very common. There's a lot of things that would be arguable business-related expenses that people think of as purely personal and don't deduct. Don't do that. This can be tens or hundreds of thousands of dollars of additional deductions that you can claim, and you won't pay tax on that money, which you probably are now. Don't miss the huge home office deduction. This has gotten a lot easier to qualify for post-COVID. A lot of tax preparers are kind of afraid of it because of the way the reg is written, but they needn't be. This is a huge opportunity to save tens of thousands, if not hundreds of thousands again. If you have kids that are employable in your business, hire them to do some work that they're capable of. Remember, they're in a zero tax bracket. So if you pay your child $20,000, which is like poverty line wages, to do that, you get a deduction for the $20,000, and they wind up getting that mostly tax-free or entirely tax-free in most cases. If you own real estate, in most states, if you rent that to your business, you wind up paying sales tax on that. There are ways to avoid the sales tax. This can save you, again, tens of thousands of dollars. If you are a real estate investor, very frequently we see that the deductions are entirely missed due to what's called the passive activity loss limitation rules. You're going to go through and give all the receipts, here's a shoebox, and all the calculations, and this is what deductions were, but you don't wind up getting any deductions because of the way the math flows from form to form. This is a very common mistake that we see, and you want to make sure that you qualify for what's called the real estate professional designation on the back of the Schedule E. Another really big one is missing qualified business income deductions, QBI. If you have an S corp or a partnership or you're a Schedule C filer, you're able to take a big chunk of your profits and not pay tax on it, completely eliminate it from the profitability calculation. But if you miss that, if you're not getting good advice, I mean, that's huge. It's leaving piles of money on the table for no reason. Another thing that we see is folks capitalizing operating expenses as startup costs when they could be expensed and deducted that year. Many entrepreneurs or their tax advisors miss cost segmentation depreciation or bonus depreciation. Again, these can be huge dollars that save you, big taxes this year or past years or going forward, and more than that. So without getting too much into the weeds, one thing I do want to mention though, which is really important, and that's qualified small business stock. And this is something that most taxpayers, and I suspect many tax advisors, aren't aware of. But properly set up in the right kind of business, you can build a company and sell it and avoid paying taxes on $10 million or more of capital gain. That's huge, right? You start up a company, you keep it for 5 years, which is the rule, and you sell it, say you put zero into it, you sell it for $10 million. That $10 million tax-free. That's huge. That's a profound opportunity for you entrepreneurs. Hopefully that puts a bug in your ear. In any event, to get more detail on this critical topic or many other important wealth education concepts, please like and subscribe to the channel to get updates on this, on the many courses that I teach on tax and asset protection, wealth preservation, investing, and all kinds of stuff. Till next time, this is Jeff Camarda, the Wealth Doctor. Hope that this is useful to you. Bye-bye.